Have you ever wondered how a huge company gets its, annual report card? Well, that's exactly what we're going to decode today. We are breaking down the income statement, which is basically the financial story of a company's year, all the wins and all the losses. So let's dive right in.
I want you to think of the income statement just like a company's report card. But instead of grading an entire school year, it really hones in on a specific period, say a quarter or a full year, to give you that clear, final grade on how they did financially.
So, here's our game plan. We're going to start with the story this whole document tells. Then we'll uncover the simple formula at its heart. After that, we'll dig into the real cost of actually selling stuff, build the full statement from the top down, and then, and this is interesting, we'll see what that famous bottom line doesn't tell you.
Okay, first things first. Let's totally reframe how we look at this thing. An income statement isn't just some boring page full of numbers. Nope. It's a story, carefully written, that shows you a company's operational highs and lows over a specific chunk of time.
Now, the official definition calls it a report of operations over time. But let's just cut through all that jargon, okay? At its absolute core, the income statement is built to answer one single crucial question. After everything was said and done, did the company actually make a profit or did it end up losing money?
So how does this whole financial story get put together? Well, you might be surprised to learn that it all boils down to one simple, really foundational idea.
And that's it, right there. That's the backbone of the entire statement. Everything a company brings in, you subtract everything it spends, and that equals its final profit. We call that final number net income. Sounds simple, right? But the real magic and all the complexity is hiding in the details of those revenues and expenses.
So let's break down those two core parts. Revenues are all the good stuff, all the money flowing into the business from what it actually does, whether that's selling laptops or serving lattes. Expenses, on the other hand, are kind of a necessary evil. It's every single dollar you had to spend to make those sales happen in the first place.
All right, now let's tackle what is very often the single biggest expense on the whole statement. It's the direct cost of whatever the company sells, which is known as the cost of goods sold, or just COGS for short.
Now here's a really important distinction to make. COGS isn't a one-size-fits-all number. For a retailer like a department store, it's pretty simple. It's what they paid for the stuff they then sold to you. But for a manufacturer, like a car company, it's the total cost to actually build the cars they sold. These are two totally different paths to get to that same line item.
For a retailer, the math is pretty easy to follow. You can see it here. You start with the inventory you already had, add in everything new that you bought, and that gives you the total value of everything you could have sold. Then you just subtract whatever is still left on the shelves at the end of the year. That number that's left over, $20,000 in this case, that's the cost of the goods that actually went out the door with your customers.
But for a manufacturer, it's a whole different ballgame. It's a multi-step journey. We have to build our way up to that final COGS number. First, we have to figure out the cost of just the raw materials we used. It's a similar idea to the retailer. We take our starting materials, add the new stuff we bought, and subtract whatever's left. That gives us our first key number. $247,000 in materials went onto the production line.
Okay, on to step two. We take those materials, and now we add the human cost. That's the wages for the people on the assembly line, which we call direct labor. Then we add the factory's operating costs, things like electricity and rent, which is called manufacturing overhead. After we account for any products that were only partially finished, we get the total cost of everything that was completed this year, a whopping $632,000.
And here's the final step that brings it all together. We take that cost of all the new stuff we just made, adjust for what was already sitting in the warehouse at the beginning of the year and what was left at the end, and voila, we get our final number. The manufacturer's cost of goods sold is $636,000.
Whew. Okay, so now that we've wrestled with the biggest expense on the books, let's see how all these pieces fit together. We're going to build out a full income statement now, from that very first dollar of sales all the way down to that famous bottom line.
Here it is, the full picture. We start up top with net sales, and right away we subtract that cost of goods sold we just talked about. That gives us our gross profit. From there, we subtract the day-to-day operating costs, marketing, salaries, all that stuff, to find our income from operations. And finally, after we account for a few miscellaneous things and, of course, pay our taxes, we land on the number everyone's been waiting for, a net income of $24,000. See how each step down tells a little more of the story?
Let's just pause for a second on that first subtotal, gross profit. Why is this number so important?
Well, because it tells you how profitable the company's actual product is. Before you even think about the CEO's salary or the marketing budget, this number tells you, are we making money on the thing we actually sell? It's a really pure look at efficiency.
And that, of course, brings us to the one everybody knows and talks about, net income, the bottom line. This is it. This is the ultimate measure of a company's profitability for that period. It's what's left in the pot after every single dollar of revenue and every single dollar of expense has been counted.
But is that really the end of the story? Not quite. In this last section, we're going to see that even that famous bottom line doesn't always give you the complete picture of a company's financial performance.
So, if net income is the bottom line, what in the world could be beyond it? Well, accountants have this bigger picture concept called comprehensive income. The whole point is to capture all the changes in a company's net worth during a period, not just the ones that came from its main day-to-day business.
So what kind of stuff are we talking about here? This is where something called Other Comprehensive Income, or OCI, comes into play. Think of it as a bucket for value changes that aren't from your normal sales. For instance, maybe a company owns stock in another firm, and that stock's value goes up. That's a real gain, but it's not from their main business. Or maybe shifting currency rates change the value of their overseas assets. These things have a real financial impact, but for tricky accounting reasons, they don't get put on the main income statement.
Here is a perfect example of how this plays out. Let's say a company has a pretty solid net income of $70,000. But during that same time, they had an $8,000 loss because of some foreign currency swings. Well, their total comprehensive income would actually be lower, down at $62,000. It just gives you a more complete and sometimes a more realistic view of how they did.
And that brings us to some really key takeaways. Look, the income statement is incredibly powerful, but you have to remember its limits. First, and this is a big one, income is not the same as cash. A company can be profitable on paper and still go bankrupt if it runs out of actual cash. Second, like we just saw, it's incomplete because it leaves out OCI. And finally, it needs context. You can never judge a company's total financial health from this one report alone.
So, this leaves us with a really fundamental question for anyone looking at a business. If a company can look amazingly profitable on paper but have zero cash in the bank, what does financial success really mean? It's a powerful reminder that the income statement, as important as it is just one chapter in a much, much bigger financial story.